Hi folks, Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 68.50, maybe 68.60, depending on when you're looking at it. That's up almost 17% for the year. So the market obviously having a very, very good year this year. And we have a lot going on. Over the weekend, we'll start with trade. Over the weekend, we had a brief Canada-U.S. trade spat, if you will, relating to a commercial that was produced by someone in the Canadian government around whether or not Ronald Reagan would support tariffs or not. So interestingly enough, that resulted in a little bit of an angry back and forth between the two countries. Perhaps more importantly, over the weekend, the U.S. and China agreed on a framework for a trade deal between the two countries, which could get signed on October 30th. So later this week, the presidents of both countries are scheduled to meet. And so we may see an actual trade agreement between those two. That would be a very big deal. These are the two single largest economies on the planet. If they can figure out a way to trade with one another, that would obviously be beneficial, particularly for certain sectors of the economy, agriculture, technology, etc. So all eyes are on that. Meanwhile, additionally, in sort of historical news, we did get CPI numbers out late last week, which were actually on the good side. Inflation in the core up 0.2%. That is softer than what most economists had been looking for. We always track core inflation, exclude those volatile energy and food prices. 0.2% is still firm. Don't get me wrong. At 0.2, if you annualize it, you still get to about a 2.5% inflation number, which is a little higher than the Fed would like to see. However, in the face of what has been seen as a very difficult employment market, that pretty much solidifies the idea that the Fed is going to cut rates when it meets later this week. Almost everybody at this point expecting another 25 basis point interest rate cut out of the Fed. And then it will be sort of, reading the tea leaves of, does the Fed give us another interest rate cut between now and the end of the year? I will just say, I think the Fed's probably going to be somewhat non-committal on that as they await, additional data. That would certainly be, their normal MO is to say, hey, we'll figure it out when we get there. So I don't know that you should look at any language coming out of them as, really committal not one way or the other. They will be data dependent. It is also earnings season. So if we tick through the positive things, we got the trade deal, we got better CPI data that enables the Fed to cut, which is a good thing. It's also earnings season. We've seen about 145 companies within the S&P 500 report. So almost 30% of the S&P 500 has reported. And so far, earnings season has been pretty darn amazing. About 8% growth on the revenue side versus about 6% expectations, and about 15% earnings per share growth versus, once again, about 6% expectations. So well ahead of expectations on the earnings side for the most recent quarter. This week, we have actually about 44% of the S&P 500 will report. By the end of the week, we'll be in a position where, the majority of companies have kind of wrapped up their earnings season. And so all eyes will be on these earnings reports, which so far have been quite good. So that's all the good news. One potential fly in the ointment out there is the consumer confidence numbers that we will get on Tuesday. Consumer confidence has been a little weaker of late. It is one of the things that I think is causing economists some concern. This idea that I've got a little bit of weakness in the unemployment space, as well as a little bit of weakness in consumer confidence that can then translate into weaker spending, which is not necessarily what we want to see. We will get that report out on Tuesday, and I think within that, a lot of people are going to be focused on a metric called the labor market differential. Most of you are aware we're in a government shutdown right now, and that actually means that the Bureau of Labor Statistics, or BLS as it's known, is unable to compile their official statistics on employment, unemployment, etc. So the Fed is a little bit flying blind right now until we can get everybody back to work and start to get those statistics published again. What may be seen as a proxy for it is contained within that consumer confidence survey. It's called the labor market differential. And what they basically ask people is, do you feel that jobs are plentiful or do you feel that jobs are scarce? And you take the difference between the number of people that say they're plentiful and the number of people that say they're scarce. And if that points you in one direction or another, it can be seen as a proxy for overall labor market health. That will be widely watched as we continue to try and tease out, just how bad has that unemployment situation gotten. Hopefully the Fed is not too far behind the curve in terms of bringing down interest rates. So with that, as always, busy week, busy time. If you have any questions, please feel free to reach out to myself or to your advisor. Hope you're having a great day, and we look forward to talking to you again soon.